Next, we shall be revising accounting standard 2, which talks about valuation of inventory. Sir, there are usually 3 types of inventories. What are those? Raw material, work in progress, finished goods. So basically, inventory is those goods which are held for sale in the ordinary course of business. What do you sell in the ordinary course of business? Raw material do you sell, work in progress you sell, or finished goods? Finished goods. Or inventory are those goods to be consumed in the or in the process of production of such sale. It is in process. It is in process means it is neither raw material nor finished goods. It is somewhere in between. What do we call that as? Work in progress. Or inventories are raw material or material to be consumed in the production process. Raw material do we sell or do we consume? We consume raw material so that we can produce something called finished goods. So these are basically your inventory ka definition. And these are the 3 types also. Raw material, work in progress, and finished goods. Now, you know the valuation of inventory. How should the inventory be valued at, sir? Inventory should be valued at cost or NRV, whichever is lower. Yes. But before this, no, sir, AS2 is not applicable for one thing, and this is quite a popular question also. Inventory should be valued at cost or NRV, whichever is lower. But for few guys, you should not apply AS2. That is producers inventory of livestock, agricultural produce, mineral ores, forest produce. If you are a producer, like a farmer grows the product. Farmer grows the product. That means he is a wholesaler or he is a producer. Obviously, after producing, will he keep quiet or will he consume it or he will sell it? He will sell it. That means that particular crop, whatever is growing, it's an inventory for him. Yes or no? Don't value that crop as per AS2 because he's a producer. For producers, inventory of agricultural produce, forest produce, and all, no, inventories are not valued at cost or NRV, whichever is lower. Inventory is directly valued at net realizable value or any other practice we say. Okay, this is only for not wholesaler. Keep in mind, they can make a case study out of this. This is not for a wholesaler. This is for the producer. Only those guys who's producing this product. Okay, for them, they need not value their inventory at cost or NRV, but directly at net realizable value. Okay, sir. For other guys, other than these guys, all other guys have to value their inventory at cost or NRV, whichever is lower. So what is cost of inventory or what and all can be considered as cost of inventory? One is the purchase cost. If your purchase cost, can you add it to the cost of inventory? Yes. Okay. Now, if you have any trade discount or non-refundable taxes, then you can add it. If it is refundable taxes means do not add it. If it is already added to the cost of purchase means reduce it. Refundable tax means on those taxes where you're getting your input credits. Okay, like that. Okay, so if it is non-refundable taxes where input credit, if it is not available, you can add it to the cost of the product. Otherwise, don't add it. If they've already added, you need to subtract it. That is one. So cost basically are categorized into 3 categories: purchase cost, conversion cost, all other costs incurred to bring the inventory to the present location and condition. These are the 3 main categories. So under purchase cost, what and all can come? The main purchase cost. If there is any trade discount, reduce it. If there is any non-refundable taxes, add it. That is one. Next is conversion cost. Conversion cost means, sir, if you are a manufacturer, what will you do? You will purchase raw material and convert it into finished goods. So to convert this raw material into finished goods, obviously you have to incur a lot of cost. That we calling it as conversion cost, and conversion costs are broadly classified into 4 categories: direct material, direct labor, direct wages, basically direct cost, and then variable production overheads, fixed production overheads. Okay. These 3, direct material, direct labor, direct cost, variable production overheads, are absorbed on actual basis. Meaning if they give you all this cost is 1 lakh, straight away you will add them to inventory to the extent of 1 lakh. How much ever you have incurred in actual, that much you can add it to the cost of inventory. However, if you have fixed production overheads means your factory ka rent and all. Okay, that is a fixed production overhead. I think overhead we know, overhead is nothing but your indirect cost. Fixed production overhead means those indirect costs. Direct cost means we can directly connect it with the product. Indirect cost means they are necessary for production, but you can't necessarily connect it with the final product. Like factory means you will only produce 1 product or you will produce 10 product. How much factory was used for one product alone? Can you clearly tell? No, difficult. Yes or no? Correct? Like factory has 1000 square feet, 100 square feet was used only for product 1. Like that, can you clearly pinpoint or quite difficult? Quite difficult, because sometimes what happens, the machinery will be spread across. One machinery will be used for multiple products like this. So is factory necessary to produce the goods? Yes. You don't own the factory. You have to pay rent to the factory. It's a rented premises. So factory ka rent, is it necessary to produce the goods? Yes. But can you directly attribute or connect it with any particular product? No. Hence we call that as what? Overheads. Overhead basically is an indirect cost. So if you have fixed production overheads, That also can be added to the cost of inventory, but on some basis. What is that basis? Fixed overheads are absorbed based on normal capacity or actual capacity, whichever is higher. You have to take normal or actual, whichever is higher. I gave you calculator example in regular class and proved it to you. Why do we take higher number? Now I'll not go into all that stuff. Okay. For now, you just remember this. Normal or actual, whichever is higher. Okay, that is one. So this is about your conversion cost and any other cost incurred to bring the inventory to the present location and condition. Suppose you're buying the goods from some other location. Let's say I'm in Bangalore. I'm buying the goods from Chennai. From Chennai, if I have to reach my Bangalore factory, means obviously I have to incur some transportation cost. That only we call it as freight. So that transportation cost, is it necessary to bring the goods to your factory? Yes. So the cutoff here is what AS2 says is such cost incurred to bring the inventory to your present location. Present location is your factory, whatever premises. And not only present location and condition. Condition here refers to sellable condition. Till the inventory reaches sellable condition, whatever directly related cost, whatever you're incurring, all that you can add it to the cost of inventory. Like transportation cost incurred, loading, unloading charges incurred, some assembly charges you are incurring. Okay. So all these charges, if you are incurring on inventory, you can add it to the cost of inventory. Till the inventory reaches your factory and it reaches the sellable condition, any related cost on inventory can be added. That's what we mean by present location and condition. Fine, Asaru? Okay, this is one. Then how do you calculate net realizable value, sir? NRV, name itself is saying net realizable value. So NRV is nothing but three components. Expected selling price minus expected selling cost, because the word is not realizable value, it is net realizable value. You may sell, expected selling price, let's say, is 1 lakh. Meaning if you sell the product, you are expecting to receive how much? 1 lakh. But to sell this product, you may have to incur some salesman commission. So salesman commission, let's say, is 10,000. What is that salesman commission? Selling cost. We are not talking about realizable value. We are talking about net realizable value. That means though you receive 1 lakh on sale of goods, entire 1 lakh came to your pocket, or 10,000 you gave away. 10,000 you gave away as selling cost. So how do you get NRV again? Expected selling price minus expected selling cost minus further production cost, if any. This further production cost is necessary for WIP. WIP means the product is 100% complete or not 100% complete. It is not complete. I mean, maybe let's say in the current year it is 70% complete and the year ended. You're already on 31st March. One product is 70% complete. So 70% complete means, can I call it as finished goods or WIP? This WIP, correct? No. It becomes finished goods only when you complete the balance 30%. So to complete this balance 30%, will it happen at free of cost or you have to incur some extra cost? Have to incur some extra cost. That's what we mean by here, further production cost, if any. So this further production cost is relevant only for your WIP. Is that fine? That's how you get the net realizable value. So find out the cost, find out the NRV, whichever is lower, the lower number will be adopted for valuing the inventory. This is the funda. Yes, sir. Okay. Remind me once, I'll discuss about this after this. First, I'll complete off everything. Next is joint products. Joint product means what, sir? You're producing multiple products, but through one common production process. Let's say one machinery you are using to produce 3 products. One machinery you are using to produce 3 products. One worker is working on all the 3 products. One worker is working on all the 3 products. Sir, product A is a separate inventory, product B is separate, product C is separate. How should each inventory, if they are separate inventory means, can you value them together or separately? Separately. That means for product A, you need to find out cost separately, NRV separately, and value. Correct. Like this is what you do. But here, are you incurring, can you tell how much cost you incur to produce product A? Like that clearly it is given or it's a common cost? Sir, you incurred, let's say 10 lakh rupees, not to produce one product, but to produce 3 products. So this 10 lakh rupees is what, sir? It's related to one cost or it's a joint cost? Joint or a common cost? Yes, no? Alright. So that is what we mean by joint products then. So you're incurring common cost to produce multiple products. So, but since each inventory is separate, each inventory cost you need to find out. So, but this 10 lakh is the total cost relating to 3 products. So in this case, what we have to do is, what the standard says is this 10 lakh of joint cost should be allocated among all the 3 products on some basis. Standard says use some rational basis. Usually they say this rational basis is sale value at split off point. This 10 lakh will be allocated in some ratio. That ratio ka first priority is what, sir? Sale value at a split off point to be say. So what does that sale value at split off point mean? Sir, let's say you are producing 3 products. 100% of the production you will do it together, or after some point of time you will segregate them. Maybe let's say 90% of production process of product A, B, C are same. For 90%, production process is same. Last 10%, no sir. For A, you will put red color, like you have cream biscuit, no? Cream biscuits, you have mango flavor, pineapple flavor and all. 90% of the production is same. Last 10% may you put, or maybe, so instead of cream biscuit, let's maybe take it as a soap. Okay, red color soap, pink color soap, that color soap. Okay, 90% production process is same. Last may you put different dye, different color. Okay, so that means that till 90% they are same. Last 10% you will segregate. So sale value at split off point means at what point of time are you splitting this product? At 90%. So find out the sale value at this 90%. What is the sale value of this product at this 90% stage? If you know that we call it as sale value at split off point. But do you think practically it will be possible to find out this? Because this is product 100% complete? No. So if you have sale value at split off point, use it. Great. If you don't have it, you use the sale value, because anyway after product is 100% complete, you will sell it. No. So use the sale value and allocate this particular cost. In sales ratio, you allocate it. That is also okay. Or based on units produced also, you can allocate. But what the standard really says is do the allocation based on a consistent and rational basis. But one basis you stick. This year I will do one sales ratio. Next year I will use production ratio. Don't go on hopping. If you are following production means follow production ratio year on year, every year, same like that. So follow a consistent and rational basis is what the standard says. Okay. In our problem, generally they will give you sales value. So you do it in sales ratio. Okay. If they give you sales ratio, if they give you sale value, find out the sales ratio. Okay, na sir. This is about joint product. Same thing I'm pretty sure you have learned it in costing as well. The drama continues, or it's the same here as well. Next is the byproduct. Byproduct is 1 + 1 offer. You wanted to produce one product. God is so miraculously working in your favor. One product you produce, another product indirectly you are getting for free. That's what happened during COVID, no? The shirt manufacturers, you know. Earlier, no, sir, when you, let's say you may insert about 500 meters of cloth. Entire 500 meters of cloth will be utilized to make a shirt, or some will get wasted. Some will get wasted. Previously, what they used to do? They used to dump it. Now they don't dump it. They dump it on our face called mask. Yes, no. Now they won't waste that product. They will sell it to that company, this waste cloth. They will sell it to that company who's making mask. Okay, that means this wasted product now has some value. That what we call it as byproduct. Though negligible, but it still has some value. So your main product is what? Shirt. But the waste cloth, whatever you are generating, becomes your byproduct, which you are able to sell it. No, that becomes your byproduct, like this. So do you think byproduct value will be very material or very small? Very small. So what AS2 says is find out the realizable value of the byproduct. At what value are you selling this waste cloth for, or remaining cloth for? Let's say you are selling this waste product for, or remaining product for 10,000 rupees. The realizable value of that product is only 10,000. What the standard says is you anyway have your main product, that is product number 1. Let's say to produce product number 1, it takes about 10 lakh rupees. To produce that main product, it takes about 10 lakh rupees. So you don't show this byproduct as a separate thing. Reduce this net realizable value of byproduct from the cost of the main product itself. How much is the cost of the main product? 10 lakh. What is the value of this byproduct? 10,000. So reduce this 10,000 from the cost of main product. So how much it became? 9,90,000. So you value the main product. So the main product or cost will not be treated as 10 lakh. Henceforth, it will become 9,90,000 like this. So byproduct, there is no separate valuation. It is reduced from the cost of the main product. That's all. Okay. Sir, what if the value of byproduct itself is material, sir? Or if you're so lucky, then you can't call it as a byproduct. That itself becomes your main product. That means in that case, you will have main product number 1, main product number 2. Okay. How much cost you incur to produce main product number 1? 10 lakh. That 10 lakh will not be the cost to produce one product. It will become a joint cost. That means this 10 lakh, a portion of the joint cost has to be given to main product 1. And portion has to be given to main product 2. That means this is not byproduct analysis. It becomes your joint product. This will become joint product only when the byproduct value is significant, which will be very, very low case. If at all it is so, then you have to do it like this. However, if it is insignificant, no need to value it separately. Reduce the realizable value directly from the cost of the main product and do the valuation. Okay, Saru? All right. Then few exclusions. So we already saw what are the costs to be included. Now few costs to be excluded. One is your general administrative and selling and distribution overheads. Okay, now receptionist salary. We are producing some goods in factory. We have in our corporate office, there is a receptionist. Now you tell me receptionist salary and that inventory, are they anyway connected? No. So that is what we mean by administrative overheads. All that administrative cost, can you add it to the cost of inventory or totally unrelated? Unrelated. So leave it off. So you cannot add. Selling and distribution overheads. Sir, there is a cutoff for inventory valuation as per ES2. What is that cutoff stage? Present location and present sellable condition. Sir, you're paying a salesman commission 1 lakh. Can I pay salesman? Can I add salesman's commission to the cost of inventory? No, because the cutoff is sellable condition. You will pay the salesman's commission after he sells the product. But the cutoff stage is after sales or before sales. The moment it reaches sellable condition, capitalization of inventory stops. So hence all this administrative, selling and distribution overheads will be transferred off to P&L account. So if they have any abnormal loss, okay, you purposely you were so negligent that a machinery has to be switched off after 5 hours. You forgot. That means that batch of product is completely wasted. Okay, so all that we call it as what? Abnormal loss. Like tomorrow, I told you we don't have class, but I took class. That is an abnormal loss, because what will you tell? Sir, you didn't inform only. Okay, so conduct the class once again. They are more than the concept. Now they're worried about tell properly. Tomorrow class is there or class is not there. Tomorrow no class. Just give an example. Okay. Next class will be on Monday. I think I gave you the schedule yesterday. No, we'll have a class on Monday at 2 o'clock afternoon, because I'm coming back a little late. Only on Monday we'll have an afternoon session. 2 to maybe 7:30 is what I'm thinking. We'll see. Okay. What the IPL? Happy. Okay, fine. So Tuesday and Wednesday we'll have a regular time, 10 to 4ish, 4:30. Wednesday I've kept as a deadline to finish the syllabus. Okay, so that is the thing. So now coming back, abnormal losses and all, you cannot be added to the cost of inventory. Then if you have any storage cost and refundable tax, I've already said. Non-refundable tax, yes. Refundable tax cannot be added. And storage cost. Storage cost of finished goods, because you will store the finished goods after it has reached the sellable condition. So storage cost of finished goods you exclude. Storage cost, however, of raw material can be added. Is that okay? That's what we mean by that. So if they just mention storage cost, always exclude it. Because we assume that if they just give you a storage cost, we assume that it is a storage cost related to finished goods. That is your exclusion. All right. Sir, how should the inventory be valued again? We told cost or NRV, whichever is lower. So you have to find out the cost. No? Yes, I was giving the cost, so it was easy. So imagine like a calculator dealer. He will buy thousands of calculators every month. He will buy the calculator at same price, or price will go on changing. Price will go on changing. Every time he buys calculator, he'll make a note of it. And every time he sells, he'll say, okay, this I purchased at 120, I sold it for 125. Like that, can you map? Difficult, right? So that means to find out the cost, because you will purchase the product multiple times and at different cost. Okay, the cost value will keep changing. It is very difficult to keep a track individually like this. Hence, they've introduced something called cost formula. Cost formula is basically a shortcut which can find out the value of the cost for the inventory valuation. That only you have learned it as FIFO, LIFO, weighted average, etc., etc. That methods of first in, first out, weighted average and all, we call it as cost formulas. Okay, so when do we use that? So first of all, what is cost formula is? First is specific identification method. Then we have FIFO, standard costing, retail. This and all you learn it in your costing. Here it is not there. All right. FIFO, LIFO and all, I think you have worked out. So I think I don't have to go in there. Yes. Sir, these three, no sir. FIFO, weighted average, standard costing and all, you will use provided inventory is interchangeable, meaning they are not, or rather they are similar. If inventory is similar, you will go for one of the three methods. Like here, calculator dealer, he purchased, let's say 5,000 units of calculator. Calculator number 1, calculator number 400, calculator number 4040, different or same? Every calculator is same, no? So whether he sells calculator number 1, calculator number 25, calculator number 40, everything is same. That means inventories are interchangeable because they are what, sir? Similar. If inventories are interchangeable, meaning if they are similar, you can use one of these methods. However, if inventories are not interchangeable, like your jewelry, okay, paintings, designer clothes and all, painting, and a painter made two paintings a painter made, okay, an artist made. Both the paintings has same value, both are same or both are different. Both are different. So one painting number 1 ka cost you have to be valued separately. Painting number 2 ka valuation also has to be done separately because they are interchangeable. Whether you buy painting number 1, painting number 2, both are same or very, very different. Very, very different. So if inventories are not interchangeable, you cannot value under FIFO, LIFO and all. You have to value them separately. Meaning if you have two paintings, you have to find out the cost of painting number 1 separately, cost of painting number 2 separately. Similarly, NRV of painting number 1 and painting number 2, you have to separately find out and do the separate valuation. Such valuation we call it as specific identification method, which is primarily applicable when the inventory are not interchangeable, meaning they are similar or they are not similar. Inventories are not similar. So these are some of the common examples. Fine, Sarji. Okay, disclosure and all, it's fine, not required. So okay, I've written there, it's okay. All right. So now let's come to some questions. 1 or 2 questions we'll quickly take care. So this question, it is there in our study material also. It is there in our class notes also. It is there in RTP May'24 question also. It's come as a case study. I'll finish up this. Any problem? Okay. Okay. It also one concept you did not tell, sir. Thanks. Maybe I'll tell off that. Maybe then I'll take up the question. So simple. Inventory, we know that has to be valued at cost or NRV, whichever is lower. But for raw material, there is a separate concept. Link raw material valuation to finished goods. You need to value the raw material based on finished goods. Meaning, if finished goods is valued at cost, then raw material also will be valued at cost. Sir, why is the separate concept for raw material? Sir, finished, how should the inventory be valued at? Cost or NRV, whichever is lower. NRV, how do you get? Expected selling price minus expected selling cost minus further production cost, if any. First component of NRV, which is what? Expected selling price. Sir, finished goods you will sell. WIP also eventually you will sell. Raw material, will you sell ever? Raw material, will you sell ever or will you use raw material? You will use raw material. That means how will you find out NRV of raw material? Because NRV means expected selling price. Raw material we never sell. Hence they said that you understood what is the pain point here. Hence they said raw material ka inventory valuation, because raw material is also an inventory. It also has to be valued. Hence the standard AS2 or Ind AS2 CFI and also same concept. They said link raw material valuation to finished goods. Because from raw material ultimately what you will produce? Finished goods. So link raw material ka valuation with finished goods. So if finished goods is valued at cost means you don't have to break your head. Raw material also will be valued at cost. If finished goods is valued at cost, raw material also at cost. If finished goods, however, is valued at NRV, then raw material also should be valued at NRV. So how do you find out NRV? Raw material you may not sell, but if your raw material gets over, what do? You replace it. If raw material gets over, if you need more raw material for your production, you will place another order, no? That means you will replace it. So replacement cost you can substitute as a NRV of raw material. Is that okay with you? So if finished goods is valued at NRV means raw material also will be valued at NRV, and NRV for raw material purpose is what, sir? Replacement cost. Okay. I'll apply this in one of the questions. Don't have to worry. Okay with this so far, everyone? So this is the thing. Since we don't have NRV for raw material, they brought in this particular new concept. That's all. Done, done. Okay. Now we'll go for some questions. So as I told, this question is there in RTP May'24 question as well. As a case study, this particular concept has been brought in. So same we have done, it's there in ICA study material as well. In a production process, normal wastage is 5% of input. Normal wastage means it's a normal loss, because no matter what you do, you cannot escape. Okay, it will happen. Okay, and normal loss we already studied in costing. It has to be absorbed by the remaining good units. So same funda here also. So AS2 also says the same thing. Normal loss can be absorbed by the inventory, but abnormal loss should not be absorbed. So now check, sir. How much is normal wastage? 5% of input. 5,000 metric tons of input were in process. So 5,000, some process may you have inserted how many meters? 5,000 meters. So and they say how much ever you insert, no, about 5% of it will go wastage. That you can't avoid it. So calculate, sir. 5,000 into 5% is how much? 250. That is your normal loss, because no matter what you do, you cannot escape from it. So normal loss is 250 metric tons or meters or whatever that you want to call it. Yes, sir. Okay. Next you come to this. 5,000 meters of input were in process, resulting in a weightage of 300. Sir, actual wastage became how much? 300. Normal loss is how much? 250. 250 we expected and we were ready. But actual loss became how much? 300. Sir, in 300, if normal loss is 250 means over and above the normal loss, if you're getting any extra loss, what is that? Abnormal loss. Here, total loss is 300, normal loss is 250, so abnormal loss is 50. Abnormal loss, can you add it to the cost of inventory or it should go to P&L? It should go to P&L. It cannot be absorbed in the cost of inventory. Is that okay? That all a question this is. Okay. Now, sir, cost of metric ton of input is 1000 meters. For 1 meter, how much is the input cost? 1000. How many metric tons have you inserted? 5000. For one metric ton, it is 1000. For 5000 metric ton, how much? 5000 into 1000 you do. How much is that? 50 lakhs. So the total cost, can I say, is 50 lakh? This is the raw material insertion cost. Other cost they have not given. This is the only cost available in this data. Yes, sir. Okay, this is the thing. The entire quantity of waste is on stock at the year end. Okay, state with reference to how will you value the inventory in the above case they have told. Okay, sir, what does AS2 says? Normal loss has to be absorbed by the remaining good units. What is the total units you inserted? 5000. In that, how much is normal loss? In that, normal loss is 250. So what is the remaining good units? 4750. Basically 5000 minus 250, which is 4750. Correct? Now how much is the cost, sir? 50 lakh. This 50 lakh of cost will be absorbed by remaining good units of 4750. 50 lakh units will be absorbed by 4750 unit. So 50 lakh is a cost relating to 4750 unit. For 1 unit, how much is the cost? How do you calculate this? 50 lakh divided by 4750, which is 1052.63. This is the cost per unit. Per unit, here they're calling it as per empty meters. Okay, sir. For 1 meter, the cost is 1052.63. Yes, sir. Okay. Sir, totally how much is your wastage? 300. So 5000 meters you inserted, 300 is gone. How much remains? 4700. Did you sell anything or they told entire is there in inventory? They only told in the problem entire quantity is there. So how many? So that means how much is units you have, sir? 4700 you have it in your inventory. Okay. Yeah, correct. So and for 1 unit, how much is the cost? 1052. So for 1 unit, 1052 will be transferred to the cost of inventory. For 4700, how much? 49,73,368. Got it? This is the cost that will get absorbed into inventory. But how much is the cost you actually incurred? You actually incurred how much cost? 50 lakh. Entire 50 lakh became part of your inventory or little lesser? How much lesser? 52,632 lesser. Yes, no. Why? Because there is abnormal loss. Abnormal loss, can you add it to cost of inventory or it has to be transferred to P&L? It has to be transferred to P&L. How much is abnormal loss per unit? How much meters of abnormal loss is that? 50 meters. And 1 meter, how much is the cost, sir? 1052.63. Multiply. How much are you going to get? 52,632. So this 52,632 represents abnormal loss that will be transferred off to P&L. Only this 49 lakh will be absorbed in your cost of inventory. That's all as a treat. Okay. This is what has came as a case study with multiple options. Select the value of inventory. You will select the value of inventory as 49 lakh 47,368 like this. Comfortable? I'll move on to the next. Yes. Okay. We just now discussed a concept around raw material. Okay. So this question is around that particular concept. Mr. Mehul gives the following information relating to item forming part of inventory as on 31st March. His factory produces product X using raw material A. So the finished goods ka name is product X. But to produce product X, we need a raw material and that raw material ka name is product A. Okay, na sir? Alright, you know its valuation already. Raw material ka valuation is linked to finished goods. If finished goods is valued at cost, raw material also is valued at cost. If finished goods is valued at NRV, then raw material also will be valued at NRV, and NRV for raw material is replacement cost. Okay. 600 units of raw material purchased at 120. So that is the cost of raw material. Replacement cost of raw material is given to be 90. Okay, they have given both. 500 units of partly finished goods. So partly finished goods means raw material finished goods are work in progress. Work in progress. So 500 units of WIP we have, and cost incurred till date is 260. So it is WIP means full cost is incurred or some portion is still remaining. Some portion is still remaining. These units can be finished next year by incurring an additional cost of 60. This is your further completion cost. Okay. 1500 units of finished product X. Product X is your finished goods. 1500 units you have. Total cost incurred on finished goods is 300 20. Okay. Expected selling price of product X is what, sir? Finished goods. Expected selling price is how much? 300. So they're saying how will each item be valued in your balance sheet? So we have three categories: raw material, work in progress, and finished goods. So first we'll have this category. Don't worry about all this story. Okay. So study material, no, sir, whenever they give you answers, they will first write story and then they'll present you the final conclusion. Sir, what should we do in exam, sir? Sir, you have to check. If they tell in the problem, calculate the value of inventory. Don't give your blade. Don't put blade. Don't give stories and all. Directly calculate and tell. That's good enough. If they ask you to say analyze, comment, then one or two blade you put. As per inventory, this has to be done. Raw material valuation should be linked with inventory. Like that, you have to put the blade there. So masala is required only if they ask you to analyze, comment and all. Unnecessarily, don't write stories. Write stories only if they ask for stories. And that too short stories, not your life story. Okay, keep that in mind. Okay, so watch out for this word. Okay, so here they just asked us to calculate. So all this extra nautanki and all not required. Directly calculate and leave it at that. Is that fine, sir? Or if you're still not satisfied, sir, it came for 5 marks, sir, feeling bad, sir, 1 line you write. Raw material valuation is linked with finished goods. That much you write. If for your satisfaction. Because sometimes we feel very bad, no? 5 marks ka question, if you finish off in 2-3 lines, you'll be like, enough. In my opinion, enough. Because they only asked you to calculate. If your mind is not able to accept it, write 1 or 2 lines extra, not more than that. Okay. Can I calculate now? Yeah. How many types of inventory? Raw material, WIP, finished goods. Okay. First, we will do it of for finished goods. Okay. Maybe we'll do it of for WIP first. How many units of WIP we have, sir? 500 units that they've taken here. Yes, sir. Sir, how much cost have you already incurred for WIP? 260. So that they've taken here. Yes. WIP should be valued at same cost or NRV, whichever is lower. How do you find out NRV of WIP? Expected selling price. So raw material WIP you will sell or finished goods you will sell. Finished goods. So that means you will not have value of WIP. Eventually WIP will become finished goods. That finished products, how much will you sell it for? 600. So take that. 300. 300. Minus expected selling cost. Have they given any selling cost? Nothing. Minus further completion cost. Do you have any further completion cost for WIP? Yes. How much is that? 60. That means what is net realizable value for WIP? 300 minus 60, which is 240. Got it? Cost of WIP is 260. NRV is 240. So which is lower? NRV is lower. So inventory will be valued at 240 per unit. How many units you have? 500 units. So 500 multiplied by 240 you do. How much is that? 1,20,000. That is the value of your work in progress. Easy. Okay. Now, can we value the raw material or first we need to value finished goods? Finished goods, because raw material ka valuation is dependent on finished goods. So let's find out the finished goods ka valuation first. How many units of finished goods we have? 1,500. How much cost is already incurred? 320. So 1,500 is a units. Cost incurred is already 300. So NRV. How do you get NRV? Expected selling price. How much will you sell finished goods for? 300. Minus selling cost. How much is selling cost? 0. Minus further completion cost. Finished goods is already completed. You will incur any further completion cost? No. That means what is the NRV of finished goods? 300. 300 minus 0 minus 0. Correct? Okay. So which is lower? Inventory should be valued at cost and NRV, whichever is lower. 320 or 300. Which is lower? 300. Keep that in mind. This 300 is what? NRV. So finished goods is valued at NRV. Each unit should be valued at 300. How many units you have? 1,500. So total valuation will be how much? 4.5. But one good thing that came out of this is we got to know that finished goods is valued at NRV. So if finished goods is valued at NRV, for raw material should we have to even think or straight away? Straight away. So how should the raw material be valued at? Replacement cost. Do you know the replacement cost of raw material? Yes. How much is the replacement cost? 90. So each unit of raw material will be valued at 90. How many units? 600. 600 into 90, 5,400. Okay. 54,000. Oh, maybe my also sapad, I think. Okay. 90, not that 90. Okay. Alright. For raw material, don't do cost and NRV comparison. Don't compare cost and NRV comparison for raw material. Is that okay? Directly write what? Since finished goods is valued at NRV, raw material will be valued at replacement cost. Directly that. Okay, Saru. Alright. One more question around probably same concept with little addition. A Limited is engaged in the manufacturing of chemical Y for which raw material X is required. So X is the raw material, Y is the finished product. The company provides you the following information. First, they've given the information relating to raw material. Cost, price they've given. Unloading charges, can you add, sir? Basically, in the last problem, cost was straight away given. Here, they will give you many cost. And you have to find out how many costs can be added, or what and all costs can be added, what and all cannot be added. Unloading charges, can you add? Yes. Freight inward? Yes. Replacement cost and all don't add. Okay. So what is the cost of raw material? Adding all this. Cost price is this plus 20 plus 40 you do. What is the cost, sir? 440. That is the cost of raw material. Replacement cost, they've given it as 300. So replacement cost is lesser, sir. We'll value it at replacement cost, sir. Raw material ka valuation always based on finished goods. So don't compare raw material ka cost with its replacement cost. That comparison is irrelevant. What we have to really find out is the value of finished goods. Based on that, raw material ka valuation will be derived. Okay. They have given chemical Y. Chemical Y is raw material or finished goods? Finished goods. Raw material consumed is how much? 440. Because to produce finished goods, we don't take raw material purchased data. Keep this also in mind. For finished goods, no sir, you are costing students. When you do cost sheet, we don't take material cost, we take material consume. In FM also we have done, I only have taught. Yeah, you don't take material purchase, you take material consume. Keep that in mind. Suppose they may give you that data also. They may give you opening stock of raw material, purchase of raw material, closing stock of raw material. Don't take purchase data and work it out. To produce the goods, no, we don't want purchase of raw material. We want raw material consume. Always have to find out raw material consumed data. So here directly they have given raw material consumed is how much? 440. That is consumption cost. Then direct labor. Can you add? This is your material cost. To produce finished goods, you need only material or you need other cost also? Other cost also. Direct labor, can you add? Yes. Variable overhead, can you add? Yes. All these are based on what? Actuals. But they've given one more called fixed production overheads. That tell me one sentence and make me happy. Perfect. Fixed. One second. Somebody is trying to intrude us. We'll send them out. Our guys. Yeah. Okay. They're checking whether things are going smooth or not. Okay. How should the fixed overhead should be absorbed, sir? Based on normal capacity or actual capacity, whichever is higher. Okay. Fixed production overhead for the year was how much? For the whole year, fixed production overheads was 4 lakh. Normal capacity is how much? 20,000. Okay. So they have not given actual capacity. If they don't give the data, will we cry about it or you utilize what is given? You utilize the normal itself. So basically, fixed overhead cost is 4 lakh. 4 lakh is for 1 unit or 20,000 units? 20,000 units. For 1 unit, because all this data is total or 1 unit level. Check the heading. This is the cost per unit. But that means fixed overhead also we want cost per unit. But what they have given as a total cost? So 4 lakh is the cost for 20,000 units. So how much is the cost per unit? 4 lakh divided by 20 is how much, sir? 20 rupees. So keep in mind, don't directly take normal capacity. Fixed overhead should be absorbed by normal or actual, whichever is higher. We have done one problem also on this in regular class. Yeah. So here they have not given actual. Suppose actual was 30,000. What you would have done? Actual was 30,000. In the denominator, you will not take 20. You will take 30 and do it. In this way, actual capacity is not given. Hence, we are dividing it by the normal capacity, absence of information. Okay, Saru. So how much is the fixed overhead cost per unit? 20. Can you add this? Yeah, that's what I've added here. Fixed overhead cost. So if you add all of this, how much you're going to get the cost of the finished goods? How much is that, sir? 460, 560, 580, 580, 660. Correct? That's if you're adding everything, you're going to get 660. That is the cost of the finished goods. Okay, now let's see the other things. Closing balance of raw material is 1000 units. Closing balance as in closing stock. There's the units. Chemical Vika, we have 2400 units remaining as closing stock. You are required to calculate the value of closing stock under two scenarios. One, NRV of chemical Y is 800. Net realizable value of chemical Y. Chemical Y is what, sir? Finished goods. Finished goods ka net realizable value is 800. What is the cost of finished goods? 660. NRV is 800. So that means you will value your finished goods at what value? 660 or 800, whichever is lower. Which is lower? Since the cost is lower, you will value it at 660 itself. Yes, sir. 1 unit will be valued at 660. How many units of finished goods we have? 2400. For 1 unit, 660. 2400, how much? This much value. Sir, if finished goods ka valuation is done, raw material ka I don't have to break my head only. How am I valuing finished goods at? Cost. So raw material also will be valued at cost. What is the cost of raw material, sir? What is the cost of raw material? 440. So 440 for 1 unit. How many units of raw material we have? Somewhere they told. How many units of raw material we have? 1000 units. For 1 unit, 440. For 1000 units, 4,40,000. So total closing stock will be this much. Done now. This is in case 1. We have another case number 2. What if NRV is 600 of finished goods? Sir, finished goods ka cost is 660, net realizable value is 600. Now you will value the finished goods at what value? Cost or NRV, whichever is lower. Which is lower? 600. That means the finished goods will be valued at NRV. Same. Finished goods will be valued at NRV of 600. How many units we have? 2,400. If you multiply, you're going to get 14 lakh, 40,000. Since finished goods is valued at NRV, raw material will be valued at cost or replacement cost. Raw material will be valued at replacement cost. Replacement cost somewhere they must have given here. Check, where is that? Here. Replacement cost of raw material is 300. 1 unit will be valued at 300. 1,000 units, it will be 3 lakh. That is your valuation. Yes, Saru? Yeah. With this inventory ka chapter, we have completed. Thank you.